Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing SoFi's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.5 billion market cap. They're trading at $10 a share, and they have 959 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. This is probably not the best type of company to do a DCF model on. As you can see, they have only negative free cash flow, so it's really hard to value. Same thing with their net income, it's negative every year. Revenue is the interest income and fees they charge. That's up about 300% from 560 million to 2 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 22 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.5 billion. We divide that by 959 million shares. And we get a calculated stock price of $9.93. So I didn't really value this company. I just showed you what their free cash flow would need to be by 2026 to justify their current stock price. So I'm not sure if I would use a DCF for a company like this. I'd probably just look through their financials and try to understand the company better. You can also use price to book, but I think you'll get more value out of this video when we look at their financials and their presentation slides in a little bit. There are 56 companies in the same industry as SoFi. They have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't need to spend too much in CapEx. They don't really buy buildings or do manufacturing. I'm not sure why some of these companies have over 1 billion of CapEx. Maybe that's the real estate they buy for their offices, or maybe it's a cost of some software capitalized. Their debt to equity ratio is a lot better than the average, a little worse than the median. So for every dollar of equity, they have $1.30 of debt. Most companies in this industry have really good free cash flow. They're a big negative. They rank 10th in market cap of the 56 companies. And price to book is probably the most important ratio to look at. And theirs is between the median and average. MasterCard is 63. We can't really look at their PE or price to free cash flow since they have negative earnings and negative free cash flow. Price to sales is worse than the median and average, but a lot better than Visa and MasterCard. They generate $2 billion in revenue, which is worse than the average. And we can't look at their 5-year annual revenue growth rate because they haven't been trading that long. So we don't have that much information on them. Let's take a look at their third quarter results to learn more about the company. They show the past 17 quarters, and the number of members they have grows every single quarter. It was 1.1 million in Q1 2020. It's currently 7 million. Since they had much less members in 2020, the growth into 2021 was triple digits on average. But now the growth is around 40 to 50%, which is still pretty good. On a nominal basis, they added the most new members this most recent quarter, 717,000 new members. On a percentage basis, it's not that high, relative to over 100% in these 2 quarters. As long as they're growing and not detracting, that's the key. So some members only use 1 product. Some members use 10 products. So it looks like the average member uses about 1.5 products, since they have 10.5 million products that are being used. So maybe your friend uses SoFi and has a loan through them, so they just use 1 product. And you have a loan and a credit card, so you use 2 products. And their product growth is also pretty strong each quarter. This most recent quarter, over 1 million new products, a 45% growth. They acquired Galileo, I think in 2020. It's a digital payments platform. And that growth was pretty strong, but the past few quarters it's been flat. They have 137 million members. It did grow 10% in the most recent quarter. That's when you compare it to Q3 2022. But it's not up that much since Q4 2022. And it actually went down from Q4 to Q1. Lending and financial services products. So their lending, their loan products are going up every single time period. They're at 1.6 million in the most recent quarter, a 24% growth. That's actually been growing more than 2021. Financial services like credit cards, that also grows quarter over quarter up to 8.9 million. That had a 50% growth. It was growing over 200% a couple quarters. But as the numbers get bigger, it's hard to grow at these percentages. And you can see that quarterly net revenue increases. It was $322 million, now it's $531 million. Adjusted EBITDA is almost $100 million in Q3, up 18%. It was only $9 million in Q1 2022. That's a big win for this company. EBITDA is an important number to follow. Their biggest moneymaker is loan origination. In the third quarter of 2023, they originated $919 million of student loans. That's almost identical to Q1 and Q2 combined. But in 2021, they averaged over $1 billion a quarter. So they're not doing as good as 2021, but much better than 2022 when they only averaged about $550 million per quarter, $2.2 billion. Personal loan origination, $3.9 billion. That's up a little from Q2, up a lot from Q1. And in 2021, they only averaged about $1.3 billion. In 2022, they averaged about $2.5 billion a quarter. So in 2023, personal loans, much better. Home loan origination, $355 million. So in the third quarter, they had $342 million of adjusted net revenue, and they had a gain of $200 million because expenses of $138 million. For their technology platform, net revenue of $89 million, expenses of $58 million, a gain of $32 million. So their margins are much better in lending products. And financial services, it's almost a break even. Revenue of $118 million, expenses of $115 million. So not much of a gain. They actually had a loss last quarter and the quarter before, because banks and financial institutions make most of their money from lending it out to others and charging a higher interest rate than they're paying. And the way financial institutions make a bulk of their money is the interest margin. I'd like to give you a simple example. If you put $10,000 into Chase Manhattan Bank, say they pay you 2% interest. Chase takes that money and lends it out to somebody at 10% interest. So they make an 8% spread on that money. They receive 10% and they pay you 2%. So they make a guaranteed 8% times 10,000. Of course, there's some risk that the person doesn't pay on their loan. That's why they charge such a high rate. So after losses, they probably still make 7%. Say 1% is chewed away from losses. So their net interest margin in Q3 is 6%. They make nearly 10% on interest earning assets. A lot of that is money they lend out. Loans for homes, loans for school, personal loans. Then they have to pay interest on the deposits. They pay a high interest rate, 4%, and they pay interest on the debt, 5.2%. So they have to pay 4.4% on their liabilities. Because when you put money into the bank, into a savings account, that's a liability for the bank. They owe that money to you. And when the bank provides you a loan, a personal loan, that's an asset to the bank, a liability to you. So 9.79% interest on their assets minus 4.44% interest on their liabilities gives them 5.99%. And you can't just take 9.79% minus 4.44%. You have to apply the 9.79% to the interest-bearing assets, apply the 4.44% to the interest-bearing liabilities, take the weight, and then you end up with 5.99%, which is pretty good. That's higher than the previous quarters, higher than any quarter in 2022, also 2023. So their margins are widening. Let's look at the value of all their outstanding loans. So for personal loans, $14 billion is unpaid. Student loans, $6 billion. Home loans, $110 million. So total unpaid principal is $20 billion. And you can see it goes up every single quarter. In the first quarter of 2021, it was $4.4 billion. In the first quarter of 2022, $6.8 billion. First quarter of 2023, $15 billion. So they're growing their business. They're getting more money in the door and they're lending it out. That's how they make money. They're still running at a loss. They have a loss per share in the third quarter of 29 cents. But as long as they still grow, eventually they're going to break even and start to become profitable. Here's a list of their assets. Cash of $2.8 billion. Remember, when they loan money out to people, that's an asset on their balance sheet. They lent out $14 billion in personal loans, $5.8 billion in student loans. Home loans, not too much, $101 million. Then the securitized personal loans, $618 million. So if you get a personal loan and you pay like 13% interest, chances are it's not securitized. It's not secured by anything. But if you want to get a lower rate, you could give them collateral. Maybe they'll have a lien on your business, a lien on your investments, a lien on a second home, and they have securitized student loans, $275 million. Credit cards, $247 million. Those are never securitized. Commercial and consumer loans, $114 million. So total loans, $21 billion. They have $1.4 billion of goodwill. Goodwill is the premium you pay when you acquire another company. So $28 billion of total assets. So when you put money into the bank, like to buy a CD or a savings or checking account or a money market account, that's a liability on that balance sheet. Right here, deposits. That's usually the largest liability for a financial institution, nearly $16 billion of deposits. But they also take on debt. They have a revolving facility for $500 million. They have a warehouse facility, $1.8 billion, because the deposits may not be enough to cover all the loans. So they may need to add some debt. It is possible they have enough money to lend out, but they may need to have a certain ratio in terms of assets and liabilities. Banks are regulated, so they may need to have a facility to take on debt in order to satisfy those ratios. They have $5.1 billion of equity. Equity is assets minus liabilities. This is the income statement on their 10Q. So the way they make most of their money is on interest income. Interest on those loans, $538 million. Total income, $564 million. They have to pay interest on the deposits. So if you deposit money with the bank, they have to pay you interest. They paid $146 million of interest. Then all those warehouse facilities, all that debt they have, they pay interest on that, $64 million. So $219 million of interest expense. So they have net interest income of $345 million, more than double from last year's number. And for the trailing 9 months, it's $872 million, more than double the prior year. They also have non-interest income, $82 million on loan originations and sales. So when they originate a loan, those one-time fees, they have technology fees, $82 million. Non-interest income, $192 million. That is down from last year. Total net revenue, $537 million. Net revenue is net interest income plus non-interest income. They have a lot of expenses. Technology, $126 million. Marketing, $186 million. Cost of operations like payroll, rent, $100 million. G&A, $124 million. They did have a big impairment, $247 million. So they would have been close to break even if it wasn't for this impairment. They would have had a negative $20 million, a loss of $20 million instead of $266 million. So you should always strip out these large impairments because they're non-cash items. They're one-time items that aren't recurring. And they've been adding shares. Last year they had 917 million shares outstanding. Now they have 950 million. Let's take a look at the stock on Yahoo Finance. Its last price was $9.31, $9 billion market cap. It looks like they started trading in January 2021 at $18.74. After the first week, it reached its peak, $25. And then it went down, then up, then down, then up again. And that was in November 2021. It was over 20 bucks. Then it really came crashing down. I think its low was a little over $4. That was 1 year ago, December 2022. It has doubled since then, but it's been kind of rocky, lots of ups and downs. If you see a green line, that means the buy orders are higher than the sell orders, and the stock price goes up. If you see a bunch of red lines, or a red line, that means the sell orders are higher than the buy orders, and the stock price goes down. So you see all these greens right here? It had a nice run up, then a red it comes down, then a green it goes up. They have a pretty high beta, 1.7, so the stock moves almost 2 times the market. It is up a lot, 117% in the past 52 weeks. The S&P is only up 25% in the same time frame. 52-week low is 424, the high is 12, and the stock is trading well above its 50-day and 200-day moving average. Lots of trading volume, 40 to 50 million shares are traded each day. Of the 958 million shares outstanding, 900 million are on float, 39% are held by institutions. A really high short percentage, 16% of the shares are shorted. Let's look at the stock on Simply Wall Street. Its last price, $10, $9.5 billion market cap, up 11% in the past week, up 114% in the past year. Let's learn a little more about the company. They provide various financial services. They operate through 3 segments: lending, technology platform, and financial services. They offer lending and financial services and products that allow its members to borrow, save, spend, invest, and protect money. It also offers personal loans, student loans, home loans, and related services. They operate Galileo, a technology platform that offers services to financial and non-financial institutions and brokerage services, as well as Technisys, a cloud-native digital and core banking platform with financial services customers. It offers checking and savings accounts, debit cards, and cash management products. They provide SoFi Invest, a mobile investment platform that provides its members access to trading and advisory solutions, such as active investing, robo-advisory, and digital assets. They were founded 12 years ago in 2011, headquartered in San Fran. Simply Wall Street values them at 35 cents. That seems like a mistake on their part. 16 analysts priced this stock at $9.59. They say it's slightly undervalued. Here's their revenue since 2017. It was $500 million. Then it came down to $260 million. Then it started coming up a lot, reaching nearly $2 billion in 2023. This is the trailing 12 months. And the forecast is for their revenue to be $3 billion by 2025. Here's their debt since 2018. It was $6.6 billion. Then it came down and it came right back up to close to that number. Their debt was a lot higher than their equity. Then their equity was higher. Now they're pretty close. Their debt is a little higher. And they do keep some cash on their balance sheet. It's currently $2.9 billion. The CEO's salary is $965,000. Total compensation $13 million. His tenure as CEO is almost 6 years. There seems to be lots of buying and selling. As you can see, lots of activity. The shares sold in the past year, a little over 1 million. The shares purchased, about 500,000. Half the companies owned by the general public, 40% by institutions, 5% by public companies, and 2% by individuals. Vanguard is the biggest shareholder at 8%. The Japanese fund SoftBank, almost 5%, then BlackRock. Morgan Stanley, 0.75%. JP Morgan, 0.3%. Goldman, 0.25%. Their employee count has been increasing over the years. It was 1,800, now they're up to 4,200. And the ticker trades in 3 places, the NASDAQ, Mexican Bolsa, and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.